everyone, this is Amit Pabari, founder and managing director of CR Forex. Wishing all the viewers a very happy Independence Day. What an eventful week it was. Full of data point, RBI का monetary policy हुआ, US का inflation data आया, and if you see the chart, Chinese currency has got weakened, Japanese currency has got weakened, 10-year treasury bond yield 2% से ऊपर आया, and dollar index have also moved up. But the interesting point to note is that rupee was relatively stable. Why rupee was relatively stable? Because RBI was intervening at higher level. Now the question is, in the NDF, rupee has closed near 83 level. Whether RBI will continue to intervene in the market or no. Let us understand that. We believe that RBI will intervene in the market. Now let us understand why RBI will intervene. In the banking system currently, rupee liquidity जो है, that is close to 2.5 trillion rupees से excess है as compared to 1.6 trillion rupees in the month of July. Now, if you see the current monetary policy, RBI has announced that any money which is deposited in the bank between 19 May से लेके 28 July तक में the bank has to put in incremental CRR close to 10%. That means that RBI wants to remove rupee liquidity from the system. ये एक part हमको समझ में आया monetary policy. Secondly, whenever RBI is selling dollars, जब भी RBI डॉलर बेचेगा तो बैंक को RBI को रुपया देना पड़ेगा. इससे भी rupee liquidity जो है सिस्टम से कम हो जाएगा. So RBI is going to use both the tool. ICRR जो बढ़ाया उससे भी and डॉलर सेल करके भी rupee liquidity को observe करेगा. Now let us understand what are the other factors which are going to impact dollar rupee pair apart from RBI intervention. On the positive side, we expect FII to continue to invest in Indian equity market because of stronger fundamentals and better current account deficit management. Apart from that, we have a solid reserves of $600 billion. On the negative side, from last couple of weeks, we have seen that crude oil price have moved from $74 per barrel to $83-84 per barrel, and it is going to have a strong resistance near that area. Second negative point is Chinese currency and Japanese currency are getting weaker because of their poor fundamentals. We expect their bank to continue to intervention near this current level. If the intervention fails, then it can move higher and it can create pressure on other Asian currencies. Third point जो है 10-year US yield is trading close to 4.1516 kind of level. If it breaks 4.25 kind of a level, it can create pressure on dollar index. Now let us discuss outlook for rupee. Tuesday and Wednesday markets will be closed on account of India's Independence Day and Parsi New Year celebration. Looking at overall momentum, it looks like that 83 to 83.25 is going to act as a very strong resistance for the pair, and we expect RBI to continue to intervene at those levels. Apart from that, as inflation in the US is coming down and it continues to be under pressure, any negative comments from any Fed members with respect to decreasing or pausing interest rate in coming days can trigger a sell-off in dollar index, which can create appreciation of all Asian currencies. So we can conclude that 83 to 83.25 is going to act as a strong resistance for the pair, and we believe that the pair will gradually move towards 82.5 to 82 kind of a level in coming days. Now let us discuss strategy for thin margin exporters like agri exporter or a chemical exporter. A lot of thin margin exporters have started taking costing between 82.5 to 82.70 kind of a level. For them, the ideal strategy is that they should cover 100% on a back-to-back basis between 82.70 to 82.90 kind of a level. If anyone wants to wait, they should keep a strict stop loss of 82.65. Classical mistake what a lot of thin margin exporters make is that when rupee is trading near all-time high, they take orders at an aggressive costing, and then they start thinking that the rupee is going to get weaker and weaker, because of which their unhedged positions start increasing, and they do not keep any kind of stop loss. And when the market reverses, they do not get chance to cover. So avoid this kind of a classical mistake. Now let us discuss strategy for thick margin exporters like textile exporter or engineering exporter. Generally, we have been taught that we should buy something when it is trading at a lower price and we should sell something when it is trading at a higher price. But human brain works differently in markets. When the price of an asset is increasing, human brain thinks that it is going to increase further, and when it is falling, we continue to think that it is going to fall further. That is because of greed and fear. Similarly, when rupee gets weaker, all exporters will think that rupees continue to get weaker and weaker. But remember, that is a trap. So for all thick margin exporters, the advice remains the same, that between 82.70 to 83.10, they should simply go and increase their hedge ratio. Now let us discuss strategy for importers. Rupee is trading near all-time low, and it does not make any logical reason that importers should go and cover imports aggressively when the view is that the pair is going to face tough resistance between 83 to 83.25. So ideal strategy for any importer is that for the next 7 days, if any payment is due, then they should simply go and take buyer's credit so that their imports are not covered at higher level. Any payment which is due after 7 days, for that they should simply wait with a stop loss of 83, and any dips towards 82.70, at that level they can hedge. With this, I will end my today's presentation. Jai Hind, Namaskar, फिर मिलेंगे next week. Thank you.